It's the start of the second half of the year, so let's look at what the market's going to do for the second half of the year.
The one area that, the market has struggled with is earnings stability, because we keep introducing these mini shocks. And so we've got great profit margins, but a little bit more earnings volatility than we would like. So I think the market is reasonably valued at this point. And the question is, can we get better earnings stability along with that profit margin?
That's Scott Helfstein, head of investment strategy at Global X ETFs. And he's talking about his outlook for the rest of this year. And it's good to get his perspective because we started the year with him discussing in January what he thought would happen. And he was surprisingly on point if you just kind of ignore all of the volatility headlines. He's our big interview, but we're also looking forward with Susan Fahey from VantageScore, where their May credit gauge showed a trend when it comes to mortgage payments, particularly that could be a little bit alarming. Plus, Matt Kaufman, head of Calamos Investments. Well, he's not looking at the second half of the year. He's looking at a change in the ETF realm with a brand new but very complicated fund that he says is the start of a new asset class that we'll be discussing with you here.
Okay, go to it.
You bet we'll go to it. This is Money Life for July the 1st. I'm your host, Chuck Jaffe. And yes, if you expect us to be out as we normally are early enough in the morning, we're a little bit late today, and I am responsible for that. I am sorry about that. But as I mentioned yesterday, over the weekend, well, actually just before the weekend, but while I was off celebrating with my family about the impending birth of my first grandchild, the South Shore Sports Center, where the Boston Box Lacrosse League, which I own, plays, it burned down. We lost our home. We had just started our summer league, and so I've been trying to salvage the rest of the summer. While, by the way, our competition has already started to try to pick our bones. So I spent a tremendous amount of time on Monday and even on Tuesday morning as we were getting the show done, having to try to determine whether or not we could play on a regularly scheduled summer weekday, which would be tonight. And the answer is no, we cannot get that done. We will be moving forward one way or another. And that just means that the show is late. Now that I've said it, okay, hopefully I'm forgiven. Sorry, it shouldn't happen again. But I can't imagine what the guys who work at South Shore Sports Center are thinking and going through and how they do this, because it's super daunting. You've got something and you've got a routine and you've got everything set up and you've done everything you need to be successful and to make it work. And then all of a sudden, poof, it's gone. I'm obviously very focused on it because I'm right in the middle of it. But when you have friends, I don't care what it is, what puts your life on hold? I mean, for me, the good news is this is something where nobody got hurt. And as much as money matters, it is only money. It's not somebody got a really bad diagnosis or somebody did whatever. And, I didn't lose my job. I can still do everything else I do, all those sorts of things. But you look and go, wow, those things, they are real. How they take it out of you is just, I look and I admire. I've got some friends who have been through some real calamities, lived through hurricanes and lost a house, or lived through fires and lost a house and things along those lines. And you go, wow, rebuilding has got to be really tough, because I'm just doing it on a minor way. Again, I've only been through it for a day or two, and I'll be able to get through this and come up with a plan and say, okay, here's how we respond and here's how we react. Let's go. I'll be able to do that. But now, of course, the market, take a look at what it's done as we got through the first half of the year. The market rebounded strongly from everything we saw that was making people crazy. I will tell you, it's a great time to be looking at the middle of the year, do a portfolio check. If you haven't done one for a while, see where you stand, because you'll probably be reasonably excited about where you are, but then you can also look and go back and do what needs to be done. How many people have we had on this show preaching diversification? You're going to get more of that today from Scott Helfstein. We've got guys preaching diversification because they don't believe that whatever we're going to see is going to look like what we've had, and you need to be able to respond to that. And if you haven't, again, what I told you with Gail and how her portfolio too heavy on stocks, so when April 2nd and the ensuing decline hit, it was really bad, and she really felt it. Well, now she can look and go, okay, I got through that. That does not mean she wants to live through that again. she wants to change the allocation and do some things that way. So it's a good time to look. And if you got questions when you go through that, chuck@moneylifeshow.com, send them to me. I'd love to answer them for you. I really want your take on what you think about this interview with Matt Kaufman, because it's very product specific, which we don't do very often. But we are talking something called auto-callable income. A number of you have expressed interest in options-oriented strategies. And I will point out, Scott Helfstein and Global X, they have them as well. In fact, I'll give you tickers right now. So in the interview with Matt Kaufman, CAIE is the Calamos fund that we're going to be discussing. It is the new Calamos auto-callable income fund. Global X does not have one currently. They have apparently been looking. I don't think they have one in registration, but you could, as an alternative, do something like their XYLG or QYLG. Those are options-based strategies that might be something of an alternative. And none of them are something that you wake up in the morning and go, oh, I need an options-based strategy. I need an auto-callable. That's for sure not happening, because I bet most of you don't know what that is. You may not even understand it after we finish. But I want to look at the new products when we can with experts so that you are on the front edge and you can go, wait, hold it. Let me size up everything, because the new products are coming so fast. I worry that people will hear something like, even here on this show, you might hear Calamos has this auto-callable thing. It sounds great because the yield is huge. Let me jump in on that. But you don't fully understand how it works, and you never considered something like the two funds I just mentioned from Global X, let alone all of the other competition out there. So please be careful, but let me know what you think. And if you want more of a product-centric stuff occasionally from us, because I am willing to do it when we're seeing some of the evolution of these new products. That's it. Let's get going. Matt Kaufman, Susan Fahey, Scott Helfstein. Talk starts next.
To navigate today's complex market, investors need accessible, quality research. Vetify offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
We start today's talk with the other interview on Money Life. And returning to the show right now, Matt Kaufman. He is head of ETF's Calamos Investments. And Matt tends to come on the show when Calamos has new products. And we don't do that with most companies. Like, we're not product-centric here in what we talk about on Money Life. That's not why Matt comes here. Yes, he's got a product that he wants to talk about. And in this case, it's a new ETF. But we're talking with him because Calamos has been on the cutting edge in developing a number of things that you're hearing about from a variety of fund companies. They're not the only one coming out with these things. In fact, the one we're going to discuss today, I think you're going to see a big wave of them. However, what they are is complicated products that as an individual investor, you don't necessarily know about. And then you hear about them and they're like, oh, wait, is that the next thing? And you don't know whether to go for it. And today, that applies to CAIE. That's Calamos Auto-Callable Income Fund. If you don't know what auto-callable income is, you're going to find out now. But I will tell you, it's this thing that I've been hearing discussed a lot of late. And if you want more information, calamos.com. Also, we have a direct link to the information page on the fund on our guest page and in our show notes. Matt Kaufman, welcome back to Money Life.
Chuck, thanks for having me. Good to be back.
So, Matt, I'm going to start with the impossible thing. The reason I have you here, you have to explain to the audience what auto-callable income is. And I mean, they may understand, yes, we're talking about options, etc., but there's a difference between callable and auto-callable, and there's a reason why you want these funds or might want these funds as an individual investor. And it's not just because you guys are putting together a bunch of stuff that we know nothing about. So fill us in.
Yeah, I appreciate the opportunity to talk about this. I would view this not as a fund launch, but as a category launch. You look at what we've done in the buffered space and in the derivative income space, the auto-callable space is about to make its way into the ETF wrapper. And that happened yesterday through the launch of CAIE, the Calamos Auto-Callable Income ETF. I think if we're talking 4 or 5 years from now, again,
the word auto call will be, rolling off of people's tongues if we do our part educating, the world, and it will be a large segment of the derivative income space that has grown so large within the ETF ecosystem. But to give you a very simple, plain English explanation, you can think of an auto callable like a bond whose income, it pays a coupon, and that coupon is dependent on the equity markets not falling too far. So in short, you're getting paid a high coupon, typically monthly, as long as an underlying index, a reference index, does not fall below a certain level. That level's for our fund about 40%, minus 40%. So as long as the reference index stays above that level, you keep collecting income, and then you'll get principal back at maturity, again, as long as the reference index does not fall below minus 40%. So what are you doing there? Why do you want to do that? You're getting differentiated income, and that's tied to deep in the money equity market risk. So there's tail risk that you're taking on. We want to be clear about that. And in exchange for that, you're getting a high, stable coupon. So the idea is to build a product, where that reference index does not fall below that 40% mark very often, maybe global financial crisis, something like that. And in exchange, you get a high coupon along the way. If I could continue on that auto call space, this is a massive industry in structured products. So in the structured note world, well, let me back up. In the derivative income world, there's about $115 billion worth of covered call ETFs, derivative income ETFs. You see JEPI, JEPQ are some of the more well-known ones. Well, in the structured product space, there's about $104 billion, almost the same size as derivative income, that's tied to auto calls. It's a massive space. It's also considered derivative income, but it's different. And so we're bringing that segment, the auto callable market, into the ETF world. And it has a whole host of benefits when you do it that way.
But auto callable is because it's its own category. There's an expectation. So help people understand where this is. And the auto call feature, does that wind up being something that comes into play when things have gone to hell and something has to happen for everything to be auto called? Like, does that happen and the auto call occur when your bonds are turning to junk? I mean, it's not a junk bond fund, but I'd put it in the high yield camp because, well, it's delivering a high yield. So is it the equivalent of that?
No, it's actually the opposite. So an auto callable, the word auto call just means that if the performance of the reference index is positive at a certain point when you look at it, like maybe 1 year from now, maybe you have a 1 year non-call period, then after that year, if the performance of the note is positive since inception, you get called away. That's how this works. So it's not necessarily a negative. It can be if you buy a single note. A lot of times advisors find it operationally inefficient because then you have to go out and buy a new note, and then you have to see what the coupon levels are. They might have changed on you. So the auto call feature in a single note, is not necessarily a positive thing. It's more of a burden, but it doesn't mean that the note went bad. It actually means the note went great. That's a good thing for you. You got called away. But when you build it inside an ETF, what we have done is we've built laddered exposure to auto callables. Instead of buying one note, $250,000 minimum, hope you timed it right, hope you mature above the barrier, we're laddering a portfolio of more than 50 auto calls, weekly ladder. So you can think of it like dollar cost averaging into auto calls continuously. If one of the notes gets called away inside the ETF, the principal gets reinvested back into the first part of the ladder. So it smooths out your income. You've always got some notes paying coupons. Some might be getting called. Some might be getting started. There's no more feast or famine experience like people have had with auto calls in the past. It reduces timing risk. There's operational simplicity. There's tax efficiency to the distributions. So there's a lot of benefits to doing this inside of the ETF wrapper, and that's what we brought today.
Help us understand what the returns will be. Where does this fit in terms of what I'm getting when I talk about fixed income?
Yeah, there's two partners to this equation, or three parties. So Calamos is the ETF issuer. Our swap counterparty is JP Morgan, biggest bank in the world, very large balance sheet. They are our swap counterparty, and we are trading swap on an auto-callable index that has been built by Mercube Indexes. They're a very large custom index provider, very familiar with the auto-callable space. So we work together to build an index, that compiles all of these auto-callables under one hood, and then we trade that index on swap. So if you look at the coupon of that index right now, it's 14.7%. So you can get high, stable income potential that's tied to an underlying equity index, and that is the Mercube US Vol Advantage Index. That's the reference index for each of the auto calls, and it's been optimized for the auto call experience. So the whole thing works very well together. Three very large leading providers, experts in their spaces, if you will, have come together to now deliver this auto callable experience into the ETF world.
So you pointed out that the coupon of the index is basically 14.7%, and the expense ratio was 0.74%. So you would basically expect the yield right now to be in the 14% range?
Yeah, I can't tell you the exact yield number because we won't make that distribution until the end of July. But what you can look at is the index that we're trading swap at. And right now, the average coupon inside that index, the weighted average coupon is 14.7%.
But I can say, because I'm not governed by the same kinds of disclosures that you are, that if the index is returning 14.7% and the expense ratio is a little bit over 0.7%, you should wind up with that solid double-digit return. That's normally how it works. How much variance from that classic way that we put it together would you expect in auto-callable?
We don't expect much variance in the ETF's coupon. The overall experience that you might achieve if you look at the historical performance of that auto-callable index looks a lot like the S&P 500. You might be a little bit more volatile, a little bit higher beta, but all of those notes are going to trade at a premium or a discount based off of the movement of that underlying reference index. And then they're going to kick off a high, stable coupon, again, contingent on that deep downside market risk. So you think of historical market events, you would have, maybe missed a coupon payment or a few in the global financial crisis. One or more of your notes might have matured below that principal barrier. So that would have been during the global financial crisis. So that is the risk that you are taking on. We want to be clear about that you're taking deep in the money tail risk in exchange for a high, stable coupon. And so the index that we're tied to has only experienced that drawdown, less than 4 or 5% of the time.
Right. But what we're really saying when we talk about structured products, and trust me, they're so hard for the average person to understand that I know that half of my audience will tell me they've already gotten lost in the terms you've been using. But the thing to know here is that we're looking at a product that should deliver high yield without necessarily much risk in normal market conditions. And if we get to those things where we're seeing super scary stuff, nothing is necessarily safe there. That's where the callable feature, the auto call feature, might wind up coming into play. And that's what people need to know. It's all easier when the numbers are bullish, but when people are scared, well, you're going to hear people talk about this kind of a fund because that's when it's supposed to help work and give you protection. And that's why Calamos and others have funds like this coming. It's the Calamos Auto Callable Income ETF. You can learn more about it at the link we've got in our show notes and on our guest page, or just by going directly to calamos.com. Matt Kaufman is head of ETFs at Calamos Investments. Matt, come up with something complicated? I'm sure we'll be talking with you about it here again on Money Life. Thanks as always for joining me.
Thanks, Chuck. Appreciate it.
We're just getting started on the July 1st edition of Money Life. Later, I'll be talking with Scott Helfstein from Global X ETFs. But next, we're talking Vantage scores. So settle back and relax. The complexity, I promise you, everything for the rest of the day will not be this complex, but it will be every bit and maybe even more entertaining. This is Money Life.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Now let's take a look at what the survey said. This is the survey said on Money Life. It's where we look at surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are digging into the latest credit gauge. This would be data for May of 2025 out from VantageScore. And we are looking at some numbers which suggest that creditors and consumers are struggling a little bit more with their mortgages than they had been before. If you want to learn more about it, it's VantageScore.com. Better yet, there's a direct link to the credit gauge in our show notes or on our guest page where you find my guest, Susan Fahey. She is Executive Vice President and Chief Digital Officer at VantageScore. Susan, welcome back to Money Life.
It's great to be here, Chuck.
I always think mortgage delinquencies shouldn't lead the way, that when we see that, it's a particularly bad sign. Because I can understand why people go, oh, I can't pay off my credit card balance, so I'll carry a balance, and we see balances rise. And then I can't pay it on time because it got too big. Like, I understand the spiral, but I always think the mortgage gets paid first, because that's what I was always taught. There's no place like home. So how bad a sign is it that we saw a surprise, and that's by your definitions of it, a surprise increase in delinquencies in May?
In May, the average VantageScore credit score remained at 702, which it's been at for several months. That indicates overall consumers are quite healthy. But you're right, we did see an increase in mortgage delinquencies, which was surprising because consumers typically prioritize their mortgage payment above all other credit obligations. And so when we look across all products, mortgage delinquencies increased the most, both year over year and month over month. And so your question about how serious is this, it definitely was surprising to us and something that we're watching. I mean, if you look at the recent ADP jobs numbers that showed the private sector cooled to a 2-year low. So I believe private sector jobs only increased about 37,000 last month, which was below expectations. So if that trend continues, it suggests that there'll be a reduction in spending and an increase in delinquencies as we move to the second half of this year. So it is surprising to see mortgage, and it's on the early stages. So it's just starting the delinquencies to increase on mortgage.
And I'm curious because I'm not sure that the data goes into it, but one of the things that I thought when I was reading this is I would be particularly surprised if the mortgage borrowers who have what has been referred to as golden handcuffs, you have a mortgage that was done before rates went up, so you're still paying 3% on your mortgage or what have you. I'd be stunned if those people were the ones where we were seeing the delinquencies rise. My expectation is that it would be with folks who, you want to go through with your house purchase that you've been planning on. Rates have gone up. You bought a house at a much higher rate. Rates are 5 or 6 or whatever that you were paying, and now you're struggling. But is there any indication that that's the case, that what we are seeing is the folks who are the more recent borrowers who, because of rates, maybe extended a little too much?
In our data, we are seeing that early stage delinquencies rose across most credit tiers. And I'm not talking just about mortgage, like overall, right? So delinquencies are rising across most credit tiers. We did see a phenomenon earlier this year where the higher end or more affluent consumer was starting to see some cracks, right, in making their payment obligations. And when we look underneath the underlying what's causing that, prices just keep rising. So insurance is going up, auto insurance, house insurance, interest rates. Although that does impact, obviously, the less affluent consumer the most, we are seeing it start to impact the higher end consumer as well.
When you look at these numbers, the other thing that I guess would be alarming, and again, maybe it's only mildly alarming because the average credit score, the average Vantage score stayed at 702, but average credit balances reached new highs. And I should point out that's again, right? The numbers are up, but they have been consistently rising just a little bit. So that continues a trend.
That's correct. So overall credit balances continue to inch higher. In May, it was the fifth month in a row where overall credit balances reached 5-year highs. And so that's, auto loans, credit card, mortgage, and personal loans all aggregated together. Those products continue to increase higher. So consumers are spending. The interest rates that they're taking, credit card balances out on remain very high. It's not a huge increase month to month, like, maybe a couple $100, but when you compare it to this time last year, overall credit balances are up about $1,500 year over year. So that's another area that we're watching.
And is there an area of that is growing the fastest? I mean, again, since mortgages and personal loans and things along those lines, car loans are on the biggest transactional items, you might think it would be there, or is it those things are holding steady and people are just spending themselves up on their credit cards?
Mortgages balances have risen the most, followed by auto loans, and then credit card and personal loans have just inched up slightly month over month.
You're trying to come up with the health of the average consumer, et cetera. How important is that 700 level? I mean, what happens and how different does it look to you if at some point you and I are having one of these calls and we say, now it's below 700?
Again, the 702 is an average across the country, and to drop 2 points or even 3 points in your example to be below 700, that would be significant if we saw that in a 1 month period. Earlier this year, we did see the average Vantage score dip to a 701, and that was due to the student loan reporting coming out. But it was just for 1 month, and it quickly went back up to 702. So if it was to go below 700 in like a 1 month increment, that would be surprising. And we don't see that happening. I mean, there might be some fluctuation where it goes down to 701, maybe 700. But right now it's been at 702 consistently for like close to a year, because it's an average across the country.
We're always talking on Money Life with investment managers, money managers, chief investment strategists, and they're always talking about the importance of the strength of the consumer. And we hear people saying all the time they hate what's going on in the economy, they're not confident, but they're still spending money. The soft data, the emotional stuff says, I feel miserable. The hard data says, I'm still spending. And the experts are looking to make sure that the spending continues because the consumer has driven the economy. Would you agree with that kind of as long as things are staying in this range at 702, et cetera, that the consumer can mostly keep going the way they've been going? And those investment experts looking at things, looking for a sign that the consumer is cracking, we're not seeing a sign that the consumer is cracking, correct?
What I would say is that oftentimes consumers, what they say is not how they are behaving, right? They could be saying they're not comfortable spending, yet we see balances continue to rise. And so just noticing this month that early stage delinquencies in mortgage saw a surprise increase. It'll be interesting to see what happens in the second half of this year. I don't know what's going to happen in the employment market, interest rates, like all of those items as headwinds on a consumer. It'll be interesting to see if that kind of changes things and makes it a different story where it's, concerns are elevated.
Well, we will be watching it, and I'm sure we'll be talking with you about it as well down the line. Susan Fahey, thanks so much for joining me on the show to discuss it.
Thanks, Chuck.
That's Susan Fahey. She's Executive Vice President and Chief Digital Officer at VantageScore, which is online at VantageScore.com. You can check out all the information on their credit gauge, the May 2025 credit gauge, by following the link in our show notes or where you find Susan on the MoneyLifeShow.com recent and upcoming guest page. Well, speaking of upcoming guests, we've got some, so settle back and relax because the big interview is next. And we'll be here with it right after this message.
Verify is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at Verify.com.
Welcome to the big interview on the July 1st edition of Money Life. Returning to the show today, Scott Helfstein. He is head of investment strategy at Global X ETFs. And on Monday, Scott and Global X released their mid-year outlook. I'm particularly excited to see it because of all the folks who we were talking with in January, Scott was perhaps the most on the money. If you go back, the headline when he showed up in January the 14th was, "This is not the nice rosy year we had in 2024. But the takeaways were that fundamentals were good and expanding, so that the market was going to broaden up and the economy would pick up in areas that hadn't done well necessarily through the end of 2024. But we would see a volatile market that should slow off a slowing pace of interest rate cuts." Pretty much spot on for what you could foresee. Of course, we had a first half that you couldn't foresee necessarily a lot. We had a lot of craziness. But yeah, as we enter the second half, you certainly want to know what's in his outlook. And if you do want to check out the outlook for yourself, well, go.globalxetfs.com, the website for the firm. There is a direct link to their mid-year outlook issued again on Monday, June 30th. If you go in our show notes or you find Scott on our guest page. Scott Helfstein, welcome back to Money Life.
Thanks for having me, Chuck.
Like I said, the forecast when you and I last spoke about 6 months ago was pretty much spot on, though you could not have foreseen exactly how the journey would unfold. Having gotten to this point, how much of a change is what you did for the second half? Like, how much did you have to overhaul, not because of your forecast didn't turn out, but because the journey was different than anyone could have foreseen?
Yeah, I mean, it's really wild that we're sitting here part of the way through the year and the S&P 500's up almost 5.5%, and it's at a record level, because certainly that was not, what we were feeling in March and through April, and certainly not for those 8 days between April 2nd when the president made his tariff announcement and then effectively pausing it on April 10th, and, also simultaneously backing off of Jerome Powell, at least temporarily. And so the components that we really had to revisit were optimism that we thought were going to drive better than expected GDP growth in two areas. The first was a manufacturing recovery, which has turned out to be, I still think, en route, but probably paused because of tariffs. And then the second was more optimism around small business investment, which obviously, those two things would have, I think, put the economy on a really, really strong basis. But I think that is now probably more of a 2026 story because, we are trying to impose tariffs, and that is going to be at least a drag somewhere in the economy.
It's interesting in that answer, you were talking about how you were hoping for a manufacturing recovery that has been paused by the tariffs. But of course, the tariffs are supposed to encourage a manufacturing recovery and, in fact, would need to encourage it very quickly. How does that resolve itself, or does that not resolve itself until we have some clarity after July the 9th?
I think it doesn't resolve itself easily because what we saw back in 2016, 2017 was in response to tariffs, we saw industrial activity pick up for the first time in years. It had basically been constant. And all of a sudden, the US started to see a little bit of a recovery, but it doesn't happen overnight. And a lot of the things that we're discussing in terms of manufacturing, things like semiconductors, onshoring, more auto production, onshoring manufactured goods, all of that takes time to ramp up because you got to build facilities, you got to invest in inventory in order to move. And so when the president came out on April 2nd, we were, quite frankly, a little bit nervous because we had modeled out what we thought were the effects of the tariffs, more so in relation to money that would be coming out of the private sector and going into the public sector, since it's effectively a tax on individuals and businesses. And then we were looking at the amount of tax cuts that would have to offset it. And obviously what they announced on April 2nd was so far beyond even our maximal outcome that we were talking about, which was 40% rest of world and 80% on China. Our base case, however, was about 10% rest of world and about 40% on China. So we've actually, after that week that really sort of shocked the markets, and look, we learned that Trump isn't offering an equity put, but he is offering a fixed income put, because that's ultimately what led them to kind of hold off and create some space, was really the volatility in the rates market, even though the equity market did go down as well. And now fast forward 2.5 months later, and we've got the market back approaching all-time highs. So I do think that there have been a few investment opportunities that unexpectedly popped up this year, driven by volatility. So that's what we've tried to highlight over the last couple months in particular, which is, even though we can't forecast the path for tariffs and a perfect path to a higher market, what we can do is identify a few categories or a few strategies that we think are going to work irrespective of additional volatility into the back part of the year.
And those categories and sectors are?
So the first one is low beta themes. This is not something that you and I really could have talked about, call it 5 years ago or 7 years ago, because thematic investing was very heavily focused on the growth segment of the market. It still is disproportionately, but there's now a whole series of themes that actually lower your risk relative to the broad market. So one of them that I would highlight is defense technology. And so we've seen a lot of interest in that topic. I do believe after the big, beautiful bill, as it works its way through Congress, the very next thing we're going to do is probably get the first ever $1 trillion defense spending bill in the United States. And meanwhile, Europe, let's say, more or less decided that they were going to meet the president's demands and start significantly increasing defense spending. Essentially, the US and our primary allies are going to be spending a lot of money. Ultimately, that's a theme where you tend to have very long contracts, stable cash flows. So defense technology is one. Another one that we've seen this year was cybersecurity. Historically, cybersecurity used to go through periods of boom and bust because it was essentially part of an investment life cycle. Those businesses have really sort of converted their models to be software as service. And so now they're making, a much more stable set of cash flows. And a couple of years ago, you wouldn't have said that it was a profitable business. It was growing rapidly. It still is. It's forecasted to do 9 or 10% top line growth, so better than the broad market. But you're talking about, margins at 15% now. And so, we like these low beta ideas. US electrification is another one, because what we can do is reduce our overall volatility of our portfolio without really having to sacrifice growth. And so that would be sort of the first area that people should be looking at. The second is growth itself, Chuck, is more profitable than it's ever been. That whole question of, do you invest in value stocks where you don't get great top line growth, but you get a good profit margin, right? You get a good cash flow off of it. Or you could invest in growth stocks where you get top line growth, but ultimately that top line growth usually comes at the expense of profit margins and profitability. That is not the case. So growth stocks now are more profitable than they have ever been. And it really makes you wonder, why are people necessarily jumping onto value? So ordinarily we think about low beta, right? Low volatility investments as generally kind of tied to value. But if we look at the factors that are working this year, value has actually not worked in terms of generating returns for the market, but low volatility has. So this is why one of the first areas we want to think about is low vol. The other one is there are themes that have sold off that haven't recovered at the same rate that the market has at this point. And so if you felt like you missed artificial intelligence, well, you can buy a basket of artificial intelligence stocks that's selling at roughly the same valuation as the S&P 500. Again, you're going to get better growth. You're going to get better profitability. You're tying yourself to the future of the economy, right? Another one to consider is something like data centers and digital infrastructure. Another area that got a little frothy into last year, and the stock market sell-off has basically given people better entry points than they had before. Again, superior growth, superior margins. So we really like, those stories. Either find your low beta or your growth at a reasonable price. And then for people who are more risk averse and they're really nervous about what's going on in the market, we've also got a section in there talking about covered calls. And so you can, own the index at a 50% or 100%, write a call against it and generate income and reduce your volatility at the same time. So all strategies that I think set up well for the back part of the year.
We kind of got out of order a little bit in terms of where I wanted to go, because we've talked about specific sectors without really giving your base case for the rest of the year. And I'll point out, you are optimistic, but you titled your mid-year outlook, Hope is not a strategy. So you are hopeful, but you are cautious. Can you quantify that? Can you tell us what the hope is that we can get, and then why we need to be cautious? What's telling you, don't forget that there is downside risk here?
Yeah, well, we've already revised down our GDP estimate, and we've already brought in our EPS estimates a little bit for the S&P 500. As of last month, when we were writing this, the consensus forecast for GDP for the year, real GDP, was about 1.4%. And we just had PC inflation reading of about 2.4. Now, the forecast is for that to go up a little bit higher, maybe 2.8, 2.9, as a byproduct of a little bit of inflation from tariffs when we finally settle on whatever the equilibrium is, right? Because right now we're kind of at this unstable equilibrium point. And that's why the Fed is sort of holding rates where they are, because they're waiting to see that flow through. Though so far, both producer prices and consumer prices have been fairly contained. But also we have to see after July 9th whether or not, we go back to some higher tariff rates that are going to filter through. But if we just take a 2.4, 2.5% inflation rate, and we look at 1.4% GDP growth, well, that's sub 4%. Our reason for optimism is that the US GDP has been growing significantly faster than that. We've been averaging 6.5% in terms of nominal GDP growth. Our theory was that, come this next revision or series of revisions, that we might be revising GDP upward. And that's exactly what has happened. It hasn't been a big upward revision, but the consensus is now for 1.5%. So we have started to revise upward. And I think we're at a point where the expectations for the economy are sufficiently muted that even without that small business investment and that manufacturing, which we kind of hoped was going to kick in this year, we now think that it's beatable. And so if we want to take a look at the stock market, ultimately where we kind of come out in terms of valuation is we focus first and foremost on profit margin, second on earning stability. Those are really two of the best predictors for valuation. And consensus forecast for the S&P is calling for 14% profit margins for next year, 13% for this year, 14% for next year. The one area that, the market has struggled with is earning stability, because we keep introducing these mini shocks. And so we've got great profit margins, but a little bit more earnings volatility than we would like. So I think the market is reasonably valued at this point. And the question is, can we get better earning stability along with that profit margin? So if we could see that, maybe, multiple should be 1 times, 1.5 times, 2 times higher. I think we're on the broad index, we're reasonably close to being fairly valued, but there probably is a little bit of upside. And then, of course, the question that we have going into the back part of the year is, will inflation remain contained? So far, the job market has been tremendously strong. For the past 3 months, we've consistently beat the consensus forecast for job growth. And so that's why Powell is sitting there at the Fed and saying, we're just going to wait and see a little bit here because job growth, he's got his dual mandate, full employment and contained inflation. And right now we have reasonably contained inflation with reasonably full employment. And the risks to both inflation and employment went up simultaneously, but not disproportionately. And so I think that that's why they're steady. So maybe two more cuts through the end of the year. Maybe we see one in September, right? Consensus has kind of gone back and forth on this a little bit, but we could see a September, we could see a December cut, perhaps. And that in and of itself could help to lift equities a little bit higher just off of that optimism.
With, as you phrased it, hope not being a strategy, and you talked about the areas that you want to go. I know that you guys have specialists that do a lot more of the specific work on international markets, but your take on international versus domestic, given that we don't have full resolution on tariffs and the rest right now?
I do think what we're seeing between the US and other international markets is not a move, it's not an underweight of the US. But for most investors, the US became disproportionately overweight. Whether it was, Asian economies who wanted access to US consumers and then was leaving those profits, dollar denominated, or whether it was energy imports from the Middle East and access to that market and then leaving profits dollar denominated, the US was the best game in town. I mean, you look at the US economy versus the other G7, and the US has grown significantly, basically at a rate that's twice as fast as the rest of the world. So I do think the move that we're seeing, the capital outflow in the US, is real, but I also think it's rational just because of how overweight people were in the US. And so what are we seeing? We're seeing some flows into Germany. Argentina has, done pretty well this year. India is another, market that's been relatively strong. The flip side is I don't think the US story is done yet. I think the US economy, despite all the volatility, has continued to hold up really, really well. The debt is a problem, but I don't want to bet against the now $3 trillion, or maybe Chuck, $3.3 trillion stimulus that's going to get dropped on the economy. I don't want to bet against that.
Let's look at now, because at the beginning of the year when you and I talked, you were already starting to formulate what would be happening 6 months out. So what's your first take on where we go to in 2026? And is that when we finally see this rough patch between hard and soft data show up? Because we can have bad feelings and soft data that's ugly, but as long as people keep spending, okay, feel bad, spend yourself out of it, and the rest of the economy seems to be going. So is a mildly higher year, the bumpy road you're talking about leading to 26, is 26 where the rubber meets the road on hard versus soft data and the rest?
If we get a large tax bill, and our assumption always was a combination, right? So tariffs are a drag on the economy. But if you're giving companies money back, particularly small and medium-sized businesses, right? The SMIDs. So if you give them money back and you can deregulate, right, or reduce regulatory burden simultaneously, that was supposed to be the driver for continued corporate investment, right? Particularly from the small and medium size. We know the mega guys are spending a ton of money, right? 250 billion in CapEx. What's happened is that the rest of the economy has dried up on the investment side. If we get a tax bill that is modestly favorable and we can get a little bit more deregulation, I actually think it's possible that in 2026, it's the opposite, where the soft data starts to catch up to the hard data around employment, around consumer spending. I mean, wages grew at 3.8%, in the last PCE report. When you have that going on and people feel like they can find jobs, and for the record, we haven't seen a debt spiral because most people had refinanced their homes during COVID at remarkably low rates. And so the impact of the Fed rate hike has been more narrow than it would be traditionally in the past. So I actually think going into 26, and it's still early to formulate going into the first part of next year. But I think it'll be really interesting to see if animal spirits reawaken and people start to feel better if we get this tax and the stimulus bill through. And so maybe it's, sentiment and small business optimism catch back up to the hard data. And that's where I would think you would kind of have that better than forecast growth. So we'll see. But, there's no question right now the soft data isn't great. But then again, the soft data wasn't great in 2022, and yet people were still spending it at 3%, 4% on a year-over-year basis.
Since hope is not a strategy and diversification is, and you guys diversify very well, and I would have loved to have taken a little more time to talk about some of those covered call strategies as they are now sort of everywhere and coming out new and different flavors all the time, including some of the ones that you guys have done. But how much are you worried that what will ultimately happen is that investors will face a downturn that to some extent is of their own making because they're not properly diversified, that diversification is a cure, but it's kind of like a leaky roof. When the sun is shining, your roof is as good as everybody else's. It's only that you find out that there's a problem when the storm is coming. So you're not predicting big storms. You are advocating for diversification. But when the time comes that people are really feeling bad about whatever the market tosses us because downturns haven't been outlawed, do you think that at this point we're going to see a storm where people are going to have to look in their own mirror and go, yeah, I kind of did a lot of this to myself?
I think that that's possible. It's one of the reasons why we talk about incorporating low volatility, incorporating growth, right? So that you can have diversification and you can control your risk level. And look, quite frankly, there's even some cyclical plays that have been lower volatility this year. Believe it or not, copper miners have been behaving much better than you would expect. And uranium has had a strong run this year as more and more of the mega cap tech guys are looking at nuclear as a way to, power the data center. So fine, the White House wants coal. I don't really see coal in the long run being the way that we're going to power the AI and the automation revolution. I think, companies are out there saying it's kind of a nuclear future. And so there's pockets you can drop in. We've seen gold move up significantly, but we also have a silver miner fund. And so there's been a little bit of a gap that's opened up. So I still think there are a lot of different places that people can go to try and avoid that. But consistently, what I will say is we all overown the Mag 7. Right? Or call it the Mag 6, right? We own them as individual stocks. We own them in active funds. We own them in passive funds. So what people I think should remember is we are actually seeing with the onset of the automation revolution, a economic broadening, even if we're not yet seeing a true market broadening. And so people that were not participating, that didn't have their margins expanding, at the end of the information age, call it 16, 17, 18, 19, right before COVID kind of triggered the automation age, those players are actually now seeing their businesses improved through AI and through automation, and they're seeing better profit margins and they're growing profit margins. I just warn people should pay attention to the economic broadening because there are really some fascinating things that are going on in the economy more broadly about how businesses are using automation to drive efficiency. And that is not just a big cap, mega cap story.
Scott, great stuff. Time flies. We've used up more than I even told you we would take from you, but thanks so much for giving us your time. We will talk to you again at the end of the year as you are putting out the outlook for 26.
And you know what? I suspect it'll be an interesting few months between now and then.
That's Scott Helfstein. He is the head of investment strategy for Global X ETFs. It is go.globalxetfs.com. There is the direct link to his 2025 mid-year outlook in our show notes today or on our guest page. And we will be back to put a bow on this show and send you on your way. But don't quit now or you won't cross the finish line. This is Money Life. We're back to wrap this one up. Thanks so much for sticking with me throughout. And by the way, tomorrow on this show, Jose Torres, senior economist at Interactive Brokers, will be our big interview. Dryden Pence makes his debut in the market call. He is the chief investment officer at Pence Wealth Management. So we've got that coming for you tomorrow. On Thursday, we, of course, will have Todd Rosenbluth with the ETF of the week. And we will have the Navigator segment brought forward today because of the holiday. And Nick Majuli, who's got a new book coming out that he'll be talking about later on this year. He, of course, is one of the top dogs at Ritholtz Wealth Management. I really like his work. He does the Of Dollars and Data blog and more. He will be here on Thursday. So great things coming. We hope you'll be here with us as we go through it. Meanwhile, and we're just going to cut out because we don't have much time here. If you are looking for something to celebrate, today is American Zoo Day. Always, I mean, I know some people say they don't like zoo. I love a good zoo. I don't even mind a bad zoo. I grew up in New Jersey near the Turtleback Zoo. And I know that there was a time when it was considered a bad zoo because it was basically, they had some places where it's like, here's an animal in a cage. And yet at the same time, they moved away from all of that. And then it would be, well, they've now got a good enclosure, but it's a small enclosure. I don't know. I'm excited for the fact that I'll be going to a zoo at some point with that grandchild of mine. Can't wait for things like that. Hopefully it'll be a good zoo, but it's Blink 182 Day because it's day 182. The band actually called the holiday for itself. They said, hey, let's make this the 182nd day, the Blink 182 Day. If that's not your music, it could be reggae. It's International Reggae Day. It is also International Joke Day.
That reminds me of a little joke.
And then it's National U.S. Postage Stamp Day and National Postal Worker Day. So you can celebrate both of them in one trip to the post office, I suppose. On the food front, it is International Chicken Wing Day. Several of you have requested in the past. I have a great recipe for baked chicken wings that they are super crispy. It's basically chemistry. A number of you have tried it. Totally worth it. I have some great sauces as well. Don't be shy. Chuck at moneylifeshow.com. But it's also National Ginger Snap Day. And if you like your ginger snaps with ice cream, then eat them with a creative flavor of ice cream because it is National Creative Ice Cream Flavors Day. My guests today were Matt Kaufman, head of ETFs at Calamos Investments, calamos.com. Let me know if you like it when we do these forays into specific kinds of products. It's not something we do often, but we do want you to be ahead of the curve in understanding what things are. Then there's Susan Fahey from VantageScore, VantageScore.com, and Scott Helfstein, head of investment strategy at Global X ETFs, go.globalxetfs.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here. Because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from comedian Jimmy Carr, who said, here's how I define rich. If having more money wouldn't change what you do, then you're rich. Yeah, it's a pretty good definition. Because you want to keep money in its proper place and perspective, whether you're rich or not. And that's why I remind you every day that until we do this again the next time, please remember that the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Sorry, you're too late.